Hey everyone, and welcome back. So as someone who is creating content in the finance and investing space, I get the privilege of talking to many of you, talking to many investors about what is happening in the markets. And through those conversations, a lot of people over the past year, including retail investors and institutional investors, believe that Warren Buffett's value investing is dead. So in other words, that value investing as we know it right now will underperform the market and do less well compared to other types of stocks, such as investing in the broad market or investing in another class such as growth stocks. So in today's video, I want to explore the reasons why value investing may be dead. I want to explain the difference between Warren Buffett's value investing and the traditional definition of value investing. And then finally, I want to help you think more critically about investing in the unique environment that we face over the next few years. Because ultimately, the more informed you are about how the stock market functions and what drives it forward, the better decisions you are going to be making for your portfolio, and then therefore the better performance you will get out of your portfolio, which is the ultimate goal. So if you do enjoy today's video and you get some value out of it, I very much appreciate it if you could take the 2 seconds to leave a like on the video. And if you want, head down to the comment section below and let me know your thoughts on the video, or if you have a question about investing, I will be answering questions as this video goes live. But with that said, let's jump straight into the video. So from what I can see, there's 3 distinct reasons why a lot of people believe that value investing is dead. And the first reason is that growth stocks as a group have crushed value stocks as a group over the past few years. So value stocks have been underperforming. And before we get into looking at the returns of these two groups over time, it's important to understand the definition I'm using when I'm saying value stocks versus growth stocks. So value stocks in this circumstance are companies with a low price compared to their last year profits. That's a price to earnings ratio that's low. And a price that is low compared to their current book value. And that's a low price to book value. And these low price earnings, low price book, traditional value stocks typically are not expected to grow their profits substantially in the future. So in other words, their profits from the previous years are expected to be fairly similar to their profits in the future. And as a result, people are willing to pay less for those stocks relative to their past earnings and relative to the equity in the company, the book value. Growth stocks are the complete opposite. They have a high price compared to last year's profits, so a high price to earnings ratio, and a high price compared to their current book value, giving them a high price to book value ratio. And that higher price that investors are willing to pay for these growth stocks is typically because investors expect that their profits will be substantially higher in the future compared to their past performance. And in order to see how these have compared over time, we can use something such as the Wilshire indices to look at the performance of returns of these groups over the past few years. The chart that you're seeing breaks down stocks into large, medium, and small based on their size, and then it also divides them into either a growth category or a value category based on their price to earnings and price to book ratios using the definitions we just went through. And over the past decade, you can see that all of these groups performed pretty similarly for the most part. But in the last few years, large, medium, and small cap growth stocks have done significantly better than value stocks with lower price to earnings ratios. And then there is the issue that overall, the PE ratio of the US market is just substantially higher than it has been in previous times, and certainly higher than the historical average. So the US market, the S&P 500, historically over the past 100 years has had an average price to earnings ratio of about 15. Now, in 2020, the price to earnings ratio, so the price people are willing to pay for the earnings businesses in the US are producing, is now as high as a multiple of 27. And this essentially means that investors are willing to pay twice as much for the same companies producing the same amount of profit as they typically are. People are willing to pay twice as much. And as a result, there are just far less traditional value investing options available. There are less great business opportunities, great investment opportunities that can be purchased at a price that has a low enough price to earnings ratio. And then the third and probably the most common reasoning I hear for why value investing is dead is that the Federal Reserve at the moment, with their large amount of quantitative easing, is driving the market, and therefore company profits are not even relevant anymore. Comparing the price to the profits the business produces doesn't even matter when the Federal Reserve is there pumping money into the market. The Federal Reserve, which is the central bank in the United States, in simple terms, has been printing trillions of dollars and funneling it into the stock market. And since the stock market, like any other market, functions on a supply and demand basis, the Federal Reserve printing a ton of money adds a ton of demand in the market for stocks and has driven prices high, all the way up to all-time highs. While if you look at the performance of actual businesses at the moment during this pandemic, many of them are struggling to survive during the greatest recession we've seen since 1929. And all three of those reasons that we just spoke about may seem very, very compelling, but I still believe that real value investing is not dead and is still a very viable way of generating substantial long-term returns in your portfolio. And before I go into explaining that, I first want to say that it is entirely possible and entirely reasonable to think that low price earnings, low price book stocks, so traditional value stocks as a group, they may very well underperform the market over the long term. But as an investor, as a value investor, you need to think beyond the traditional definition of value investing if you want to have success in the markets. Warren Buffett's definition of value investing, for example, is very, very different to the traditional definition that a lot of institutional investors use and a lot of the ways that people categorize stocks in terms of growth stocks versus value stocks. As a quick recap, traditional value investing is defined as businesses with a low price to earnings ratio and a low price to book ratio, whereas Warren Buffett's definition is that an investment is worth to you only what it can deliver in profits. So what that basically means is that instead of comparing the price you're paying for a stock to last year's earnings or earnings in the past, you should be coming up with a reasonable expectation of what profits the business can produce in the future and then compare that to the price. And in some cases, that means as a Warren Buffett value investor, you are going to be looking at low growth companies where, as we mentioned, their past earnings look quite similar to their future earnings. And as a result, you will be making a value investment in a company with a low price to earnings ratio. But it's also the case that you can make a value investment in a business with a relatively high price to earnings ratio, particularly if it's reasonable to expect that their profits in the future will be substantially higher than their profits in the past. This is why using something like a discounted cash flow calculator to estimate what price to pay for a business makes a lot more sense than just looking at the price to earnings ratio and saying, hey, it's a price to earnings of 8, it must be cheap. Doing that doesn't really make any sense because ultimately what you get out of that stock is the profits that that business produces in the future, not what they produced last year. And while for many companies, last year's earnings may be a good indication of next year's earnings, there are a lot of companies where that is not the case. And recently, over the past couple of decades, we have seen the birth of a new type of company that can substantially grow their profits in the future far easier than businesses could 30, 40, or 50 years ago. Take Google and Facebook, for example. Google and Facebook as a group control the majority, 90+% of the online advertising industry. And online advertising through Google or Facebook is substantially more profitable, more efficient for businesses than traditional avenues. And as a result, naturally, businesses are moving their advertising spend from traditional means such as television, newspapers, billboards, and that sort of thing onto online platforms, mostly Google and Facebook. And it costs Facebook and Google almost no additional investment to handle $100 billion worth of advertising on their platform versus, say, $50 billion worth of advertising on their platform. So for them to scale up requires very little additional investment, and as a result, they are growing their profits at a substantial rate. And if you focus on real value investing as defined by Warren Buffett, it can be the case that a business that meets a traditional growth style stock definition can also be a value investment in terms of Warren Buffett's key principles. And those core Warren Buffett principles will always be relevant over time. They're just the core of what investing is in any asset class, honestly. But there is something different that is happening over the next 5 years. It's happening at the moment and probably over the next 5 years that you really need to think about, and that may change the way that you think about approaching value investing. And that is that interest rates at the moment are practically at zero and may very well stay at zero for the foreseeable future. The way that investors think about investment returns is relative to alternative opportunities, right? What good is a 15% return on a stock if the government is offering you a guaranteed 25% return? That 15% is only good if it is relatively stronger than the other opportunities that are available to you, of course, adjusted for the risk associated with different investments. And one of those easy to measure alternative investment opportunities is investing in US government bonds. And at the moment, those US government bonds, which are considered risk-free in the investment world because the US has never defaulted on those bonds are currently offering near zero returns. So in other words, the returns that you can get from a risk-free alternative investment are lower and far lower than they have been at any other time in history. And to demonstrate how dramatically different today's environment is to other times in the past, I want to draw a comparison of interest rates and the PE ratio of the markets from today compared to 1980. In 1980, interest rates were above 15%, sometimes as close as 20%, and the PE ratio for the market was below 10. And this makes perfect sense. If the government is giving you a near risk-free 15% return, then if you're buying a risky stock market investment that may or may not deliver you the profits that you expect, you are going to be demanding an even higher return on those investments. And as a result, the price you're willing to pay for those stocks is down, and that reduces the PE ratio. So it makes perfect sense that as the risk-free alternative rises, the price to earnings ratio of the market goes down. And we can compare this to today in 2020, where interest rates are zero and the price to earnings ratio of the market is an astounding 27. So in today's environment, because the alternative safe investment is offering you near 0%, investors in the stock market are willing to accept pretty much any return that is better than a near 0% return. And that means that investors are willing to pay nearly anything for a stock that drives up stock prices and therefore makes it more challenging for you to find a safe, great business that's offering you a safe 15% return or more over the long term. And historically speaking, the environment that we're in right now has happened before, and it has historically been unstable. It has not been sustainable. That has either resulted in interest rates rising and the stock market coming down, or profits being drawn up to reduce the prices for stocks and the stock market not really going anywhere for a while. But ultimately, we really don't know what is going to happen. We don't know if this low interest rate environment is going to last for a significant length of time. So what should you do? How can you position yourself when you don't really know what's going to happen and where no one really knows what's going to happen? And my view is that you should position yourself for both outcomes, okay? In the case where interest rates rise as a result of inflation picking up because of all of this spending in the market, and as a result, stock prices come down and revert to their average prices compared to earnings historically. So prices come back to average, which would mean that the stock market would need to fall about 50% for that to happen. But in the event that that does happen, you should have cash around to invest in those opportunities. And at the same time, you should also be betting on the stock market. You should be investing money in the stock market, maybe not all of your money, but you should have some money invested in the stock market consistently, while recognizing that when you're investing at valuations that we're seeing right now, the long-term returns for those stocks are likely going to be a lot less than historical. So historically, the market on average has delivered about 6 to 10%, depending on what time period you're looking at. But if you're investing at these high valuations, you should expect far less out of your portfolio. For example, let's take some of the stocks that I invested in March of this year. Some of those businesses since March are up over 100%. Which means if I am adding more to that position now compared to when I was investing in March, the long-term return I will get out of that investment from what I'm putting in now will be half as much as if I had invested that money at prices at March levels. So that is the difference between buying at these higher valuations. It will have a significant impact on your long-term returns. But of course, making 10% on $100,000 is far better than making 15% on $10,000. And considering we don't really know whether the stock market will crash in the near term, even though historically when valuations have been this high, that has happened, we don't really know that that is what is going to happen. And as a result, I would much rather invest some of my money, maybe slower than typical, but still investing money at a lower return than just keeping all of my money on the sideline. Because even though some of the stocks in my portfolio, if I add to them now, I will be making half as good of a return as when I was adding to them in March, I guarantee that that return is still going to be better than the 0.5% that you can currently get in a savings account or a long-term government bond. And if you have no idea about anything that I just explained in this video and you also have no interest in understanding it, then the easiest thing that you can do is do what 99% of people probably should be doing, which is investing in a broad market index fund, something that tracks the Australian market or the US market or the global markets, and just add to it consistently, regardless of what is happening. And sometimes you'll be adding when the market is expensive, like at the moment, then it might crash and you'll be adding more when it's cheap and you'll be accumulating a lot more shares and a lot more value in those index funds. And over the long term, if you add consistently, that has been a very, very good strategy for building wealth over the long term. And of course, if you want to learn more about stock market investing and develop your understanding of how the markets function and then also individual stock analysis, which is kind of what we specialize on this channel about, then make sure you head over to my channel and check out some of my other videos. And of course, hit subscribe if you haven't already. Recently, there's been a lot of viewers that are not subscribers. They're just watching my content. So if you do want to get updated and you want to get updated when I'm posting regular videos, hit that subscribe button and hit that notification bell next to it so that you're notified when I'm posting. But other than that, hope you guys enjoyed today's video. I'm looking forward to seeing your comments down in the comment section and answering some of your questions and answering some of your comments. But other than that, hope you guys have a great day and I'll see you in the next video.